Good afternoon and welcome to our first Libro Credit Union's first home savings account webinar. We appreciate you taking the time to join us, whether you're watching it live or watching this on a replay. And jokingly, I said earlier about accelerating through the content at slightly accelerated speeds, but we hope to find the content valuable and look forward to engagement. My name is Paul McQueen. I'm the Vice President of Wealth Management here at Libro Credit Union. I will be joined by Doug Carroll, a tax and estate specialist from Aviso Wealth, and I'll tell you a little bit about Doug momentarily. I certainly want to welcome you on behalf of our approximately 130,000 owners that we serve and our credit union across I know this number says 119, but it's moving up, and our 34 locations across Ontario. This is certainly with respect to B Corp and purpose-based business model that we have here at Libro. These kinds of conversations around financial wellness are really important to us. We know that home affordability and accessibility to that home affordability are real issues for many Canadians, especially younger Canadians. And we do believe that opportunities to use products like the First Home Savings Account combined with great coaching are one positive step to making that dream of home ownership a reality for more Canadians. In terms of how our call operates today, we certainly will be open to getting questions and feedback from you. Please, if you can, use the Q&A button that should be available to you on your screens. Look like little thought bubbles with some question marks in there. We do find that general questions work best. If you have a question that's really personal or really specific to yourself, we will encourage you to speak to one of our Libro coaches, or you can access us through the website if you don't have a specific Libro coach. We'd love to hear from you. But if you have general questions about how the First Home Savings Account works, tax treatment, contributions, etc., that either aren't answered in the presentation or you're confused about, hey, throw them into the chat. We'll be happy to address them throughout the call. And don't worry about furiously scribbling notes. We will make a recording and handout available on our website and in a follow-up email to registered attendees after the call. So moving forward, I'm going to introduce Doug Carroll. Doug Carroll is the tax and estate specialist with Aviso Wealth. Aviso Wealth is the wealth management securities management dealer partner to credit unions across Canada, like Libro. Doug previously ran an estate planning law practice and was an advanced case consultant with both a life insurer and a mutual fund provider. Doug holds a business degree and a master's of law, specializing in tax. He is qualified as a certified financial planner professional and a trust and estate practitioner. He's been doing this for over 30 years, now supporting our financial advisors, written articles to individual case consultations, and of course, webcasts like today. We're excited to have you. And Doug, I will turn over the First Home Savings Account presentation to you.
Great. Thank you, Paul. And thanks everybody for joining us here for the session here about the FHSA. Just like a lot of acronyms and tax acronyms, you hope that they turn into a word that makes it flow a little bit better. That's the best we can do here. I had a friend, a colleague, who said that he thought this would become known as the FISH program, just because there's an SH in there, reverse order. But I'm not going with that. I'm just going with FHSA. We are in the midst of election campaign right now, and this was proposed during the course of the last election campaign, and then was brought into law over the course of the next year or so after the Liberals took government in 2022. I can't remember exactly when our elections were last. But this was actually brought in and made available in 2023. I'll talk a little bit about the timing of these things. So here are the topics that I'm going to get into, about 10 topics here, and fairly plain text type of presentation to you so you can see what's going on. As Paul mentioned, there is a recording, number one, and number two, a corresponding written piece, which runs the same order as the slides here. So the headlines in that are very much what you're seeing up on the screen, and you will see in the text that are on the individual slides. So you don't, again, have to be typing. Good for you if you can type, scribbling wildly. If you have a notebook in front of you, you are certainly welcome to, and happy to hear from you on things that you might pop into the Q&A. We'll have a bit of a discussion on it. It is a fairly new program, and so I'm keeping larger text on the slides right now, more so than what I do with other presentations where I might just have the lead high level bullet and then speak to the sub points. In this case, because it would be quite unfamiliar territory entirely to a lot of people, or just very newly known material, I'm keeping the details up there. So I'm not going to read it off to you, but just gives you an opportunity to see what we're doing with each of the topics. So the program was promoted at the time when it was part of the election campaign, and throughout during its introduction in the federal budget in 2022. It was promoted as having the best of both worlds of RRSPs and tax-free savings accounts, TFSAs. And that's a reference to the fact that you get a deduction when you put money into one of these plans. You get tax sheltering while the money remains within. And then on withdrawal for a first home purchase, you then are not taxed on the withdrawal. So you get a lot of boosters by making use of this plan. So we'll start with just chronologically how things operate. An account opening, you have to be within the range of 18 to 71 in order to open an account in provinces where the age majority is 19. I'm not sure which ones those are. Then you'd have to wait until you're 19. But otherwise, there's your range of time to open up a plan, to keep open a plan. And I'll talk about the time at which a plan has to be closed, which includes upon reaching the age of 71, but that's further towards the end. You have to be a Canadian resident in order to open a plan. But if you become a non-resident before you draw money out, then you don't have to collapse it. You can keep it going, but you can't take qualifying withdrawals, as in a withdrawal which is non-taxable for the purpose of a first home purchase if you were a non-resident at the time of the withdrawal. There are two definitions for first-time home buyer. Apologies for making this confusing before I even go into the point here, but there are two definitions. One at the time that you open the plan, and then further on, I'll talk about being a first-time home buyer at the time when you take a withdrawal for the purpose of making that first home purchase. There's just a small variation in the definition. At the time when you open a plan, you cannot have owned, or you cannot currently own, a residence in which you reside in the current year or any of the 4 preceding years, uh, where that is a residence which is your principal place of residence. And that includes that you can't be living in a property in that same time frame where your spouse or common law partner is the owner of that property, whether that is jointly with you or separately from you, strictly under that person's own name. We'll get into, right towards the end, we'll get into the coordination of this new plan. I'll still call it new plan. It's only 3 years into it right now. We'll get into the coordination of this new plan with other types of savings options you have. You can make use of the home buyer's plan out of the RRSP structure. You can also make use of the tax-free savings account, and both spouses can participate with all of those plans. And you may have money, obviously, in other places that you are using towards your down payment on the home. But we're talking mainly in the context of this topic about tax sheltering plans that you can make use of. So getting money into the plan, there are two ways that you have money going into a first home savings account, either as a direct contribution, a new contribution to the plan, or as a movement of money that is currently in an RSP that you then transfer over into the FHSA. When you make a direct contribution, a new dollar contribution into FHSA, you get a deduction, or you're entitled to a deduction, but you are not required to claim that deduction in the year when you make the contribution. And I'm going to give you an example. It's the government's own example of how that carry forward operates. So just hold off on that. A very important point to be aware of is that unlike RSPs, despite that I say, and that it's been promoted as being the best of both worlds, that you get a deduction like you do with an RSP, it's important that you think of it as like you do with an RSP, not exactly the same as what happens with an RSP contribution. The first 60 days of any calendar year, you're allowed to put money into an RSP and use that contribution to apply against the preceding year's tax filing that you are doing currently. Actually, you got another 2 weeks to get your filing in for 2024. That's fine for RSP contributions, but with the first home savings account, the actual year when the contribution is made is strictly when you can take the deduction or carry forward into a future year. So there's no retroactive way that this can operate where you make that contribution after year end and then wish to use it to reduce down the immediately preceding year's tax bill effectively. It doesn't work that way. So depending on your situation, and I'm going to assume that some of the people here are themselves saving, and others may very well be parents of children who are near or into that age bracket and stage of life. Be aware of the contributions being calendar year based very specifically. Also, and I'll come to this in more detail about closing down FHSAs. Once you have taken a withdrawal from the FHSA for the purpose of a first home purchase, you can't put any more money in. So if this is something, particularly in these early years, where you're not entirely clear on how it works, and so you're trying to make as best use of it, the timing of when money comes in and when money comes out can affect its ability to be a deduction. Once you have made a withdrawal, even though the withdrawal is for a forthcoming purchase that might be months ahead in time, you have drawn the line in the sand. If you make that withdrawal for the purpose of making that purchase, then you can't put any more money in after the point at which you take money out. The other way, apart from making a direct contribution, the other way that you can get money over into the FHSA is to have money that exists inside of an RSP moved over into an FHSA. You don't get a deduction for doing that. You got the deduction when you made the contribution into the RSP at some time in the past. And when you move the money from your RSP over into the FHSA, you don't get a recovery of the past used RSP room upon which you were able to make that contribution. The transfer should be a direct transfer, and you see down at the bottom there's a new form that is used for this purpose. The financial institution will assist you in making sure that this is the form, and you should verify that if you're going to do this, that the transfer is made from your RSP directly over into the FHSA. If you don't use the form, then you run the risk that the money taken out is an RSP withdrawal, which then would be a taxable amount to you in the year when the withdrawal is made, and there would be withholding tax on that depending on how large the withdrawal is. So the gross amount that you think that you're getting over into the FHSA ends up being a net amount available to then put into the FHSA if you pulled out of the RSP, and you don't want that to happen. And in that case, if you did that, you would end up with a taxable amount of your RSP withdrawal and then a contribution directly into an FHSA, which would be a deduction. So the net tax result would be no tax on that two-part transaction, but in the meanwhile, you'd have that withholding tax that would apply that would reduce the money that's available to get over into the FHSA. So the recommended best practice for doing this is to use the form to get it over into the FHSA. You can take money from a spousal RSP if you are the annuitant of a spousal RSP and your spouse contributing to that plan. You can take money from a spousal RSP to go over into the FHSA, but because of the anti-avoidance rules with spousal RSPs that apply to the first 3 years when money is placed into the RSP and the year that of the contribution and the 2 subsequent calendar years, there is a set of rules that affects the withdrawals that a person takes from that spousal RSP that will attribute the tax on the withdrawal back to the contributor. I suppose that they could have come up with a variation on how that would apply when you use that with an FHSA, but they just gave a blanket prohibition that you cannot take money from a spousal RSP in that 3-year time frame and migrate it over to an FHSA. So keep an eye on that if you had intended, or you would intend to use spousal RSP money for that migration over into FHSA. In terms of the dollar amounts, there is a lifetime maximum that can go into these plans on a per person basis. And so if you think of this as 2 spouses or would-be eventual spouses who are fiancés, you each can make use of this. The lifetime maximum is $40,000, and the annual limit that you can put in is $8,000. Now, there is a limited carry forward. So unlike, let's say, RSPs and TFSAs, where you have unlimited carry forward to future years, and you can use up past unused room in any future year. Subject to RSPs, you can only put money in until you reach the age of 71. With the FHSA, you have up to 8,000 that can be carried forward. Just hold on a second. I'm going to show you that example along with the other carry forward of deduction room. And I think it's the next slide, but I'll move to that. So there is a carry forward, but not an absolute full-blown carry forward. If you over contribute, like all of the tax shelter plans under Income Tax Act, you have a hefty penalty that applies. It's 1% monthly as a penalty. And so you don't want to over contribute. It's not something you want to play around with and say, oh, I can make a better rate of return than 1% per month, which is, again, just cumulatively would be 12% in a year. Just not a good idea to have an over contribution. So be conscious of where you've made contributions, how much you've contributed, particularly if you're contributing in different places. Even if it's with the same financial institution, it could be that you're doing it with GICs at a branch level and then with the wealth department with an investment account. Just be careful that you don't over contribute, particularly again, if you've got separate organizations where you're making contributions. If you have those relationships, then you could run into an issue where you see this penalty applying. And then in terms of the investments, pretty much the same kind of investments that you can put into RSPs and TFSA. So you can do high interest savings accounts, you can do GICs, you can do stocks and bonds and mutual funds going into the FHSA. It's maybe exactly the same definitions. There used to be a distinction between a significant distinction or a notable distinction between RSPs and RIFs versus tax-free savings account, but pretty much all the same common investments you would use can be used with the FHSA. So here's the 2 carry forward illustrations that I wanted to show you. Again, these are the government's own, other than changing the dates involved, because the announcement of the FHSA was in the 2023 budget. I brought these forward the years, so they apply in current times a couple of years later, but the content is essentially the same. So when you make a contribution into an FHSA, you don't have to use the deduction in the year when it happens. And the example that was offered here is that Nagia opens the FHSA in 2024 and puts $8,000 in it. But last year, 2024, was a low income year, which would mean that taking a deduction would not be a very valuable deduction if it could be pushed forward or carried forward and deducted against higher level of income. Then you're negating higher bracket tax rates. And so that's what she's going to do here. She makes a further $5,000 contribution this year in 2025. There's no other transactions, so no RSP transfers into the plan. So her total is $13,000 that she's put in between 2024 and 25. And then once she's done that, oh, I messed up my calculation here. It's 2000. It's 8,000 from 2024. The second line should say 5,000, and the lower figure there should be 13,000. Sorry, but the text version of things shows you that she used 13,000. My tally there uses the wrong figures. So that's the carry forward and use of the deduction in this case. And so for her, she wouldn't claim that deduction until we get around until next year when she files her 2025 taxes, once we get past the end of 2025. So nothing will be claimed when she files before April 30th this year. And then the other type of carry forward is where you haven't used the room that is available to you with the FHSA. And as I mentioned, this is a limited carry forward. So in this example, Sian Ho opens the account here in 2025, but doesn't put anything into it. It is opened, and therefore it's available to put money into, but then he doesn't do anything until he gets out to 2030. In the interim time, the between this year 2025 and 2029, he could have put in $8,000 as carry forward in the years in between, plus the current years at whatever time he did it, allocation of $8,000. So he does this in 2030, and he gets his 2030 room of 8,000, and he puts another $8,000 in from his past years. So he's putting in 16,000. You can see where I got the numbers when I move things in my boxes here. The error over there on the left-hand side. But here, this is correct on the right-hand side. The carry forward usage that he has is 8,000 for 2030 and 8,000 for the past year. So he can put 2,000, or he can put $16,000 in the year 2030. So now we come to the point where it becomes usable, or is decided to be used. And the term that applies to using the money in the FHSA for a first home purchase, it's referred to as a qualifying withdrawal, as opposed to generically a withdrawal from the account. That is requiring that the withdrawal is used for a first home purchase. It is non-taxable, to repeat the point over and over, and it must be a first home or a new home purchase. Whether that is a new home which is being built, or it's a purchase of an existing structure, it would be your new home as the person who is buying that. And here, this is the other slightly different definition of being a first timer as a first time purchaser. So the criteria here is, once again, that you, at the time when you use the plan, you cannot have owned a place as your principal residence in the current year and the preceding 4 years. So it looks exactly the same up until this point, except that when you consider whether your spouse has been an owner, it only requires that you personally cannot have been an owner of the property in that time frame, current year and the minus the preceding 4 years. You on title to the property. Your spouse could be already an owner of property. So as an example, let's say that you opened it when you were in your early 20s, and then you met your future spouse 7-8 years later. You've had this accumulation in the plan, and the two of you, your spouse who you met, has a property that he or she owns, and a couple of years later you decide, hey, let's buy a new place. And when you do that, then you, as long as you didn't go on title to that property, you haven't owned in the preceding time frame. And even though your spouse has, and that's been the place the two of you have been living, when you then make the purchase of this next place and you go into together, you are allowed to make use of the FHSA withdrawal and not be taxed on it. The criteria as listed here are that you have to have a written agreement. It's not just an intention. There has to be something that shows a legal contract that you have to either purchase from someone else or with a construction company that is building a home that you are buying from. When you take the money out of the plan, you must occupy the property by October 31st of the following year. So that's important in terms of the timing of qualifying as a qualifying withdrawal. If it's a new home purchase that is subject to potential delays, then or known as to when the expected occupancy will be, then you'll have to be conscious of that in deciding whether to take money out before or after year end. For example, if you take it out in December of 2025, you have to be occupying that property by October 1st of 2026. But if you think that it's going to be later, then you might want to wait until January to take that out in 2026, and then that gives you another year to occupy by October 1st of 2027. You have to or you can acquire the property uh, 30 days before the withdrawal. So it's kind of hard to explain how this works, but basically you can have acquired the property and then take the money out of the FHSA. You've got that 30-day time frame. I know that's going to lead to a question, and I'm going to defer on how to explain that to the written piece that we have. That's much better than me trying to come up with an explanation of that without reading it off myself. Importantly and usefully, there is no minimum number of days that you have to have the money remaining there in the FHSA. So you could put the money in, and actually I had two separate nieces, separate family nieces, who were in this situation, who bought one last year and the other one this year, and made use of this, having become aware of the FHSA and didn't have weren't ready to accumulate for it. The money that was already earmarked outside of the home buyers plan that they were using, the money that was already earmarked for the purpose of down payment, then they were able to, in each case, put the money into FHSA and then days later take the money out. They got the deduction for having put the money in, and when they took it out a few days later for a qualifying withdrawal first home purchase, they then were not taxed on that money coming out. Had they just taken that money, which was sitting there in their checking account or their savings account, and just use it for the purchase, then it would have been $8,000. That was a reduction based on reduction of their cost of purchasing as part of the down payment. In this case, it was an $8,000 deduction that then went in and came back out and helped them out on a very narrow time frame in both cases. So apart from those qualifying withdrawals, it's also possible to take money out of an FHSA and not be for a first home purchase. I would say that this is not something that you would necessarily intend to do. Maybe that there was a change in circumstance that you have to tap into that money because you have a difficult financial situation that you've come across unanticipated. It could be that perhaps you have money in other places that's materialized, maybe by an inheritance or some kind of other windfall, and so you don't necessarily have to use the FHSA for its core intended purpose. So if you take money out and you don't use it for a first home purchase, then it is going to be taxable. But, and this is one of the nice concessions that comes with the FHSA, but if you take that money out and rather than just spending it, you wanted to put it into your RRSP, you can do that. You can pull money out of an FHSA and put it over into an RRSP without having to use any of your existing RRSP room. In fact, you don't have to have any RRSP room to pull the money out and pull the money out of the FHSA and put it over into the RRSP. It's a bit of a backdoor way that you might be able to increase RRSP contributions for retirement purposes. And I'm not suggesting that that you actively look at doing this, but it is an interesting feature which the government has consciously allowed for people to make use of. The follow on from that is that you might expect that once you have taken money out of an FHSA for any purpose, if you're going to use it to to spend, then you would think the government would say, all right, well, if you're not going to use it for its intended purpose to buy a home, then you're going to have to shut it down. But that's not the case. If you take money out for a non-home purchase, so it's not a qualifying withdrawal, you are not required to close down the FHSA. If you take it out for a home purchase, you are required, and that's where I think that's the very next thing I'm going to touch on now is what happens on the closing down of accounts. It's not the next one, yes, it is. I'll take you through this now. So for the close down of the account, there are three potential deadlines that will cause you to have to close down all of your FHSAs. It's December 31st of the earliest of the three dates that we have here in the bullet points. So if you take money out of an FHSA for a first home purchase, that's a qualifying withdrawal, then by December 31st of the following year, you must close down all of your FHSA. So it's not on a per account basis, it's just withdrawal of any amount that is to be used as a non-taxable part of the down payment for a first home purchase. All of your FHSAs must be closed by the end of the following year. As a timeline of how much time you can accumulate money in an FHSA, it is 15 years. So it is December 31st of the anniversary of the first contribution you make to an FHSA. So as I was just saying, it's not on a per account basis for the withdrawal causing all of those accounts to close. More importantly, to make sure you have it clear on how this operates, when you put money into any FHSA, the year that you do that, sorry, not that when you put money in, when you open an account, even if you don't put any money in, once you have opened an account and it's recorded, because the financial institution will then record your social insurance number, and that will be part of its exchange of information with the Canada Revenue Agency. Once you open an account, then the 15-year time period starts counting from then. If you open a different an account of a different type with the same institution the next year, or a different institution, might even be the same type of account. Maybe it's that you have GIC that you opened for FHSA one year, and then the next year you decide you're going to do another type of account, again with the same institution or another one. All subsequent FHSAs will be caught within the 15-year time period based on the first account opening that you do. And then the other possibility is that you reach age 71. So if you open an FHSA after you are 56 years old, then the 15-year time period would technically go past 71. And so, and this was actually based on the original draft of the legislation, this was possible that you could have savings over into an FHSA, which would go past age 71, but they changed that so that all FHSAs must be closed by the end of the year, by December 31st of the year that a person turns 71. So those are your three possibilities that will apply. When you close down the account, if you're not using it for those for the first home purchase, and you're closing it down, you're withdrawing the money, that money will either be taxable to you, it'll be added to your income in that year, or once again, you can use this as a way to migrate that money over into your RSP or directly into a RIF, which RSP is an accumulating vehicle, a RIF is a drawdown structure. Otherwise, they're both tax sheltered plans, which are directed towards drawing down your money in your later years. There is this specific form that is used for the purpose, and so you can transfer the money from your FHSA not used for a first home purchase either into an RSP or directly into a RIF structure, if that's your preference to do it that way. If you pull the money out of the FHSA, which then becomes taxable in the year that you pull the money out, then your ability to go into either RSP or RIF will be limited. With the RSP, you would have to have RSP room in order to then put that money over into an RSP. And you cannot make a direct contribution into a RIF. The form that is new to be used for the FHSA will, however, allow for that money to go into one or the other, depending on what your preference is again. So with these plans, you, like a lot of tax sheltered plans, you do have the ability to name someone, one or more people, as beneficiaries on the plan should you die while owning one of these plans. And most likely, well, you're young people. It may not be that in all cases, obviously, it may be that there is a spouse or not a spouse. But if there is a spouse, and if you name the spouse, I'll just say spouse. So, spouse being legally married and common law partner being not legally married, but someone for tax purposes who is your other half for tax filing purposes. There's a whole variety of ways that you can have a spouse or common law partner who is the recipient of the amounts in the account. And what that person can do with those amounts depends on their situation at the point of your death. Sorry to keep on killing you off here, but that's the event that causes the beneficiary designation or successor annuitant to come into force, or successor holder, sorry, not successor annuitant. So if you name your spouse as successor holder and that person fits the definition of a first time purchaser at that time, then that money, the account that you have it in will remain, the contract will remain as is, and then your spouse becomes the holder of that account. So there is no disposition of the holdings that are within it and no payout of the amounts. It's just a change in terms of who owns that. Alternatively, if your spouse is named as a successor holder, as you're entitled to do, but that person does not fit the definition of a first timer at that time, then the money in the account must either be paid out as a taxable amount, but it can go over into an RSP or RIF without requiring the room in order to do that. Alternative to naming your spouse as a successor holder on the existing account is to name your spouse as a beneficiary on the account, or you also can use your will as the document that affects the beneficiary designation of the account. And in that case, the contents of the account are then paid out, the holdings within it are cashed out, and the contents, the value is then paid over to that person. And you have that same distinction. If that person as survivor is a first timer, then he or she can have that money go into an FHSA without using up the person's own FHSA room. It's just that you have to go through this two-step or multi-step process of cash out, new contribution into FHSA, whether it's an entirely new FHSA contract or an existing plan that the person has. And in doing so, it will not affect that person's FHSA room. If they don't want to have that money continue on in FHSA, again, they can take it out as a taxable amount, a taxable distribution, or they can have it go over into the RRSP or the RIF. And then the last possibility, as I mentioned, is that the person is named as an estate beneficiary. You get all of those same options there. If the money comes to that person via your estate, then once the amounts are paid out to them as an estate beneficiary, they get the same options to either go into an FHSA if they're qualified, or have those amounts go to RSP RIF or be a taxable amount in their hands. For any other people who you name as beneficiaries, the payments out of the FHSA will be taxable. They will be taxable to that, let's say it's one person for simplicity, they will be taxable to that person. Compare that though, if this was an RSP. With an RSP, the amounts in your RSP upon your death are deemed to be disposed at the point of your death and brought into your own income. And yes, there are rollovers that can happen if you have a spouse rather than it being taxable to you. But the starting point is that those amounts are taxable to you as the person who owned the account, whether it's an RSP or a RIF, in the year that you die. And then if there's a beneficiary designation on that plan, then the financial institution will pay the amount over to the person who is named as beneficiary. So let's say that it was $1,000 RSP. Obviously, RSPs would be much larger in almost all cases, but let's say it was $1,000. If on an RSP you named someone non-spouse, you named your parent, let's say, as the beneficiary on the RSP, if unfortunately you were to die while holding on to that, $1,000 will be brought into your income as the in your terminal year, January 1st to the day that you die, and you would be taxed on that in that final year. But the full $1,000 would be paid over to the person you name as beneficiary. So just to emphasize the point, the person who owned prior to the point of death is the person who is taxed on the amount that's in an RSP. But with the FHSA, same dollar amount, it's $1,000, the parent who you name as your beneficiary, or whoever it might be, non-spouse, mind you, that person receives $1,000, and that person is taxed on that $1,000, not your estate. So it's a little bit different treatment than what happens with RSPs. I've preserved this point about naming a beneficiary early on with the FHSA. The way that our tax rules operate, we have the federal rules that create, under the Income Tax Act, the Federal Income Tax Act, create some types of tax sheltering plans, which dictates the tax treatment of those plans and the logistics involved with setting them up and administering them. But the power to name a beneficiary off of any of these types of plans, that is a power over property. And under our constitution, the provinces have the authority over over property matters. So in each case, for all the provinces, they have legislation which allows for the naming of beneficiaries immediately after the federal government enacted the FHSA legislation. The provinces would not have had the rules in place to allow for the beneficiary designations, which effectively the Income Tax Act opens it up to being able to name a beneficiary. But in order to close that loop, the province has to give authority to do so, which is a fairly straightforward arrangement. Depends on province whether it's something that has to go through the legislature at the legislative level, or if it's something that's done by regulation, which doesn't require as much operation from the legislators. I believe that now that all the provinces, I can probably get rid of this point, all the provinces have gone ahead and done that. But in the early stages, you were able to open an FHSA, but you could not name a beneficiary because perhaps your province hadn't gotten around to it. Maybe you were excited and motivated, you got it going, but the province didn't do so. I do keep this in part because if you had done this, opened an account and weren't able to make a beneficiary designation at that time, ideally your institution would have prompted you as soon as it was possible to make a beneficiary designation so that you finish things off in terms of setting it up. But maybe you did this directly on an online basis, and the institution has not yet gotten back to you and said, "Hey, we really think that you would probably like to name a beneficiary off this plan should the unfortunate happen," but they haven't yet got back to you. So if that is the case, that you opened up one early on and it doesn't have a beneficiary designation, get back to the institution and get that rolling. In the unfortunate situation where people separate, our spouses at a point, but then they go their separate ways, the ownership of an FHSA, it is property which is owned by respectively the individuals in the couple, and those assets are both um, assets that may be subject to division between the two of them at the point of being separated, as well as being able to roll over between the two of them should that happen. So you can transfer over to your spouse, or again, or common law partner, as I'm using the phrasing. You can roll over to your spouse, that can go into that person's own FHSA if they qualify as first timer, or into an RSP or RIF, in all cases not using up the recipient side of the room in doing so. On the other hand, not recovering that room either on the part of the person who is effecting the transfer of the account. There does have to be something official. It's not just you doing that at your own whim. There has to be either a court order or a written agreement between the parties in order for that rollover to happen, whatever the plan is that's intended. If there is an excess amount, so as I was warning, being careful about over contributions are subject to large penalties. If there is an over contribution amount, then the over contributed figure does not roll over. It's only the amount which is within the boundaries of what the person is entitled to. Now, that might seem to some of you to say, well, that's obvious. If you're offside, you can't transfer over the offside amount. Why would you bother doing that? Well, it could be that you are offside as the person who is going to transfer, but your recipient spouse has not made full use of their FHSA room. And so you're thinking, oh, well, it's a couple $1,000s over in the transferor's hands, the would-be transferor's hands, and there's more than $2,000 of room in the recipient's hands. We'll just transfer over the whole thing, and the excess will then be soaked up by the fact that there's room on the receiving side of things. But that's not the way that it works. You have that excess that's in there that has to be taken out of the plan. Only the fair market value, which relates to the allowable contributions, will then transfer over. Again, it doesn't affect the receiver's unused room, but again, doesn't recover from the transferor, and there is a form that is allowed for the purpose. New form that's allowed for the purpose. So the last thing I want to do is just give you a little bit of a side-by-side, and so you can see, just recapping first on the FHSA, and then I'll show you the RSP home buyers plan with just a few bullets and the tax-free savings account. So key features of the FHSA upon contribution: you get a deduction, you get the $8,000 of annual room with that limited carry forward of up to 8,000 from previous years, and then you get 40,000 as your lifetime maximum. When you take a withdrawal, it is tax-free if it is for that first home purchase. The amount you can take is whatever it's accumulated to. There's no dollar maximum on the amounts that you take out of the plan. And if you take the money out, but you don't use it for first home purchase, then it's taxable, but with that backdoor opportunity to go into an RSP or RIF. With the RSP home buyers plan, which has been around for decades, When you put money into your RRSP, you got the deduction when the money went into the RRSP, and that's why the promotion of this was always or has been the best of both worlds. Deduction like with an RSP and non-taxation like with a TFSA on withdrawal. So you get the deduction on going into the RSP from which you may use the home buyer's plan, and as far as the amount that you can make into the RSP, that depends on your earned income. It's not something which is directly related to the usage of the home buyer's plan. When you take a withdrawal, I refer to it as tax deferred because as long as you pay the money back in over the course of the following 15 years, there's a schedule that begins the year after you take the first withdrawal from an RSP for the home buyer's plan. As long as you repay over the course of that time period, then you are effectively taking a loan from your RSP and then putting it back in. The maximum you can take under the home buyer's plan is $60,000 now. It's gone up over the last few years. It was in recent years, it was 25,000, then it became 35, and now it's $60,000 per person that can be taken from the RSP home buyers plan. And there was early on, there was the limitation that was in the legislation that said you can use either the TF or the FHSA or the home buyers plan on a purchase, and then the government backed off on that and is allowing for you to use both of these plans. And then the tax-free savings account, you don't get a deduction when you put money into a TFSA. The current annual room, which is a per year annual room, it's indexed from time to time. Currently, it is $7,000 of room you can put into a TFSA, and you have that unlimited carry forward of TFSA room. And then on taking money out of a TFSA, generally, regardless of what you use it for, it is tax free. The amount that you can take out is just whatever it's accumulated to. I put it down as unlimited there, just depends on how you've invested it and how it's grown. That's what I'm referring to there. And one of the nice things about the TFSA, and it's just a feature of the TFSA, which is irrespective of what you do with the money, is that whatever you pull out of the TFSA, you get a dollar for dollar ability to recontribute a credit that arises the following January the 1st. So it gives you a little bit of a side by side of the three plans that are tax supporting of making a first home purchase. Paul, I see you're back on again, and so I'm going to stop and turn it back to you.
Yeah, no, if you could actually go back one screen, the question is with
Sure.
respect to some of the transfers, and apologies if you covered this off, but the transfer to the RSP from the first home savings account, what impact would that have on future contribution room on the first home savings account? Or does it have any impact on the contribution room?
It has no effect on future contributions on the FHSA. You get that 8,000 per year and the 40,000 lifetime. If for whatever reason you decide you're going to take some out of the FHSA and not use it for first home purchase, then you are otherwise taxed on it, but you can shift it over into RSP. It doesn't affect, it doesn't give you anything back for FHSA room. It doesn't reduce your RSP room. It's just a movement of the money over into the RSP. If you are consciously accumulating towards making a home purchase, I can't think of an example that would make sense to push the money from FHSA over to the RSP and then use the home buyer's plan as part of the drawdown. I would be inclined to just keep the money over in the FHSA. You can still use the home buyer's plan for the money that's in it already, but I don't see where you would gain anything. And I'm sure the person who asked the question isn't trying to strategically work this around, but
No,
just
and that's absolutely
be
not.
aware.
We've got a couple questions in here too around the priority or sequencing amongst the first home savings account, home buyers plan, and TFSA. And our answer to that is always going to be, if you're not sure, talk to a coach, someone like our Libro Wealth advisors, because there are going to be different circumstances, different realities, different income levels, different tax implications, et cetera, et cetera. And you certainly want to take the time, if you're not sure, Hey, number one, if you're not sure, get started, because getting started somewhere is better than not getting started at all in terms of your savings. But if you're not sure which account is sort of the best one for you to maximize or coordinate or whatever, our coaches would be happy to help. So I got one or two more questions if we have time, Doug, but I'll let you finish up and then I'll come back on.
Nope, that's it. I'm done. You can pepper me.
All right, excellent. A good question that came up, one of the anonymous questions, but do you think the government will consider increasing first home savings account limits? No pressure, put you on this. We got a federal election going on right now. But do
Yeah,
you think they will increase the limits, given that housing prices continue to, generally speaking, rise across the country?
do I think they'll do it? I don't know. I mean, that'd be crystal ball gazing politically. I think that you have to bear in mind, and again, we've all seen the polls about what may happen here. Uh, if the conservatives take government, then I would be surprised, even if they like the idea, that they would bolt onto a liberal anytime soon. I mean, bolt onto a liberal government or liberal party announced program, even if they feel that it's a good program. I don't think they would jump on that. The Liberal Party, though, if they form next government, may look at that as a possibility. The thing is only 3 years old right now, so I don't think that anyone wants to be tweaking too much with it. I will reveal my own preference among things. I would rather have them increase the FHSA room and shut down the home buyers plan, allowing for people who have accumulated in their RSPs with expectation of using the home buyers plan to get some kind of concessions to be able to do that. And the reason I say that is that you do have to pay money back into the home buyers plan and otherwise be taxed on the withdrawals that you had taken if you don't pay the money back in. Whereas the FHSA is a cleaner way to do things. So I'd like to see some kind of a transitional uh, elimination of the home buyers plan hand in hand if there's an intention to bump up FHSA room, because as I was showing on the numbers there, 60,000 that you can take from a home buyers plan. If instead there was a beefed up version of the FHSA in a few years' time, once they've got some experience with it, my preference would be that type of arrangement, because it's a better deal financially for people. Deduction on the front end, non-deduction on the back end with the FHSA, whereas the RSP, it's deduction and then the home buyers plan, a requirement to repay. Otherwise, you do get taxation on having used the money in the home buyers plan. So yeah, but I don't know.
Perfect. Well, one last question. You got to answer it in 2 minutes or less because we're going to run out of time here, Doug.
Yeah, sorry.
Um, if we're fortunate enough to have parents or grandparents or the like who might want to help us out with these kinds of, is there any benefit to the parents or grandparents contributing to a first home savings account? Can they give it to the owner of the account? Like, what's the best way if a parent wants to support a child, for example, or a grandparent? What makes the most sense to you?
Yeah, everyone expects in most family situations that the parents or the grandparents are the higher income versus the younger generations, and so those parents or grandparents would like to get the deduction involved, but they can't. They can give money to the children, the adult children, who would be the owners of the FHSA, but it is the owners of the FHSA that would get those deductions. They can support them to be a source of money to go into the down payment overall, uh, and then having provided some money, then allowing for the child to make the contribution into the plan and get the deduction. So it
If
was one of the
it's
first questions that was posed when the thing was implemented
Yeah.
was, hey, can the parents or grandparents get the deduction? And the answer is no.
Okay. And just real short answer to that, I mean, if it's truly a gift, say from mom and or dad to the child, are
Mhm.
there any tax implications to mom or dad if there's no expectations that it's paid back?
No, no, unless the source of the money is something that mom or dad owns, which has to be sold, and there might be a capital gain that they'd be subject to. If you're just talking straight up cash, there's no implications to them tax wise.
Okay. Well, perfect. Well, thank you, Doug. I appreciate it. I know this is a bit There is a great program and a great opportunity here to help Canadians with their home, their pursuit of their dream of owning a home. And we hope and believe that the first home savings account, used appropriately with your other savings options, can certainly help more Canadians do that. And we're here to help. If you don't have a trusted advisor out there that you're willing to talk to or able to talk to, then please pick up the phone, go on Libro.ca, find one of our advisors. We'd be delighted to have this conversation with you. Thank you to Doug Carroll from Aviso for joining us today. Thank you to everyone on the call for joining us about the first home savings account. And we look forward to continuing this conversation in the future. Have a great day, everybody.
Thank you.